Welcome to the deep dive. Today we're getting straight into a really fascinating, maybe even controversial book. R. Nelson Nash's Becoming Your Own Banker.
Yeah, it's definitely one that sparks debate.
It really does. It proposes, well, a pretty radical shift in how you manage your personal finances. We're here to unpack the blueprint for what he calls the infinite banking concept, or IBC.
And our goal today really is just to clarify what Nash is actually proposing. He's very clear this is meant as education. It's not a sales pitch.
Right.
It's all about the financing possibilities within a very specific tool, dividend-paying whole life insurance. And the big mindset shift, the thing you really need to grasp, is that your need for finance during your life, paying for things, starting businesses, cash flow that need, is actually much, much bigger than just your need for a death benefit someday.
Okay, let's try and simplify that core idea right away.
Right.
The main goal seems to be stopping all that interest payment leakage, right? The money going out to banks, to finance companies for cars, school, homes.
Exactly. You want to recapture that interest. Keep it within your own controlled system.
But he stresses this isn't a quick fix, not at all. Nash was a forester, and he uses that analogy, like planting trees.
Yeah, he talks about managing timber. You have to think long-term, decades ahead, even intergenerationally, maybe 70 years out.
Wow.
It absolutely needs that long view. You're planting these financial seeds now, but the big harvest, the real benefit, might be for you later in life, or even for your kids or grandkids. It's a very different time scale than typical retirement planning.
So the book kicks off by showing why this is so urgent. It uses some, frankly, pretty sobering numbers. Talks about the all-American family.
Right. And based on studies of spending habits, the average 29-year-old, even earning a decent income back then, they were paying out something like 34.5 cents of every single after-tax dollar just on interest. Mortgages, cars, credit cards, the works.
34.5 cents, just interest.
It's just interest. And what really jumps out is the sheer volume. Let's say that person's doing great, saving 10% of their income, which is, double the average rate.
Still good.
Still good, but they're paying out nearly 3.5 times more in interest than they're managing to save. So their focus is, kind of skewed. They spend all this energy trying to squeeze out an extra 0.5% return on that little 10% they save. While completely ignoring this massive 34.5% waterfall of money just flowing out the door to someone else. Gone forever.
That's where the airplane analogy comes in, right? Nash was a pilot.
He was. And he says it's like flying your financial plane at, say, 100 miles an hour.
Okay.
But you're flying directly into a constant 345 mile per hour headwind.
Oof. Okay.
So trying to tweak your engine to go 105 mile per hour, it's almost pointless. The environment itself is overwhelming you.
So the lesson is stop obsessing over the plane speed.
Right.
And start focusing on controlling the financial environment you're flying in.
Exactly. And gaining that control means understanding how money moves. The book talks about this idea of the money pool.
The money pool?
Yeah. All capital, all money flows from this one big pool. Banks use it, insurance companies use it, individuals use it. IBC's goal is to let you gain essentially 100% control over the slice of that pool that you need to finance your own life, without asking permission from banks for every big purchase.
Okay, so before we get into the how, let's just hammer home that basic principle again. You finance everything you buy, period.
Absolutely. You either pay interest to someone else for a loan,
Or
you give up the interest you could have earned yourself if you just spent your savings. That's opportunity cost. There's always a cost of financing.
right, no free lunch.
No free lunch. And realizing that points directly to the engine of IBC, which is, as we said, a specifically designed dividend-paying whole life insurance policy, usually from a mutual company.
Okay, the goal recapturing interest sounds fantastic. But let's tackle the elephant in the room. Standard financial advice often slams whole life. Says it's too expensive, grows too slowly compared to, say, market investments. How does IBC get around those high fees and slow growth issues?
That's a really important question, because an IBC policy is structured differently from a plain vanilla whole life policy that's just focused on the death benefit.
Okay, how so?
Well, the owner's power comes from their contractual right to borrow their cash value, 100% of it. Anytime, any reason, you're first in line for your own money. But to make it work like a bank, you need that cash value to grow, and grow significantly faster than normal.
So how do you accelerate the cash growth? Without, triggering tax problems with the IRS?
Right. It comes down to engineering the policy correctly. Two main things. First, using what's called a paid-up additions rider, a PUA rider.
PUA rider.
Okay. Think of it like an optional turbocharger. It lets you put extra cash into the policy above the base premium, and that extra cash immediately buys small chunks of fully paid-up insurance, which makes the cash value itself grow much, much faster.
So it's like prepaying future insurance, but getting immediate cash value growth.
Sort of, yeah. It dramatically accelerates the cash accumulation side. And the second thing is you need to, as Nash puts it, snuggle up to the MEC line.
The MEC line, modified endowment contract.
Exactly. If you fund the policy too aggressively, too fast, it becomes a modified endowment contract, an MEC, and it loses some of its favorable tax treatment, especially on loans and withdrawals. So a properly designed IBC policy pushes as much cash in as possible using that PUA rider, getting right up close to that MEC limit, but without actually crossing it. That maximizes the tax-advantaged internal growth.
Okay, that makes structural sense. But what about the dividends? You mentioned dividend-paying whole life.
Yeah.
How are those dividends treated? Are they taxed?
That's another key part. The insurance actuaries, they deliberately build in a buffer. They might collect, say, $1.10 in premium when they estimate they only really need 0 to 80 cents for costs and reserves.
Okay, they overestimate costs.
Right. And that extra 30 cents, the surplus, is later returned to the policy owner as a dividend. But here's the crucial bit. Because it came from you overpaying the estimated costs in the first place. The IRS classifies that dividend not as earnings, but as a return of premium. So it comes back to you tax-free. But even if you have the perfect policy, perfectly structured, the book is really blunt that IBC will absolutely fail if you don't conquer some basic human tendencies.
The behavioral finance side.
Exactly. Nash lists 4 big ones. The first is Parkinson's law. You know this one. Expenses rise to equal income.
Oh, yeah. Get a raise, find new ways to spend it.
Precisely. Without strict, almost ruthless discipline, any extra cash flow you generate from your IBC system just gets sucked into funding a slightly nicer lifestyle. And the system never really gets capitalized.
That's a tough pill to swallow, but true. Okay, what's the second challenge?
It's about power. Nash quotes a cynical take on the golden rule. Those who have the gold make the rules.
Meaning?
If you don't have your own capital, you always have to go to others' banks, lenders, and pay their price, play by their rules, just to get access to finance. IBC is about accumulating your own gold so you start making the rules for your financial life.
Okay, controlling capital. Got it. The third pitfall involves the government.
Yes. Willie Sutton's law. Willie Sutton was asked why he robbed banks, and he supposedly said, because that's where the money is.
Okay.
Nash applies this by saying, wherever wealth gets accumulated, someone will try to take it. And he points to the government, particularly through taxation, as being very effective at this. This leads him to issue a strong caution about government-sponsored plans. Things like 401ks, IRAs, HR-10s in the U.S.
Whoa. Okay, that's a big statement. Millions of people rely on those plans. What's the specific warning in the book?
The warning is that these plans, 401ks, IRAs, they exist only because the government created exceptions to the tax laws for them.
Right, they're tax advantage.
Exactly. But because the government created the rules and the exceptions, the government can, and history shows, often does change those rules. Tax rates change, withdrawal rules change, contribution limits change. This introduces a huge amount of future uncertainty, what Nash calls a potential retirement trap.
Regulatory risk.
Huge regulatory risk. By contrast, he argues, the whole life insurance contract used in IBC is private property. It's a private contract that actually predates the U.S. income tax system by well over a century. It operates under different, much older legal principles, largely outside those easily changed government statutes.
That's a really important distinction, private contract versus government program. But even with a private system, you still need discipline, right? Which brings us to maybe the hardest part, the grocery store analogy.
This one is critical. Imagine you own a small grocery store. If your family just constantly takes food off the shelves and out the back door without paying the full retail price, you're stealing from your own business.
And the business will eventually fail.
It absolutely will. Applying that to IBC. You must pay back the loans you take from your policy. And this is key. You have to pay it back with interest at a fair rate, probably similar to what you would have paid an outside lender like a bank.
So if you take a loan for a car,
you make loan payments back to your policy, not just the principal, but interest too. If you balk at that, if you say, hey, wait, it's my money, why should I pay myself interest? Nash says you are acting like that thief taking groceries out the back door. You're destroying the very banking function that allows the system to grow and fund the next purchase. You kill your own bank.
Wow, that really hits home. Paying back a bank is one thing, but having the discipline to consistently pay back yourself, with interest?
Yeah.
That takes a serious mental shift.
So how do you actually start this? Implementation needs a strategy. The book strongly advises not trying to tackle your biggest debt, like your 30-year mortgage, right out of the gate.
Why not?
It's just too big. You need to build up your bank first. Start smaller with things you can definitely achieve, like financing your cars or maybe some business equipment, things with shorter terms.
Okay, so build momentum.
Exactly. And that requires what Nash calls a capitalization phase. You need to feed the system first. Maybe for, say, 7 to 10 years, you focus on paying substantial premiums, maybe using that PUA rider heavily, perhaps $5,000 a year, maybe more, whatever you can manage, to build up a decent pool of cash value to start borrowing against.
Got it. Capitalize first, then borrow.
Huh.
Now let's talk results. The book compares IBC, which it calls Method E, against conventional saving, like putting money in a certificate of deposit at a bank, Method D.
Right, and the comparison highlights the key differences over, say, 44 years. With Method D, the CD, any interest you earn is taxed, and the real profits from financing things along the way go entirely to the bank's shareholders.
Good.
With Method E, the IBC policy, you get the guaranteed cash value growth, plus those non-taxable dividends. And when you finance things by borrowing against the policy and repaying it with interest, that interest also flows back into your system. You recapture it.
And the long-term difference is significant.
It's dramatic. Using Nash's specific car financing example over 51 years, the conventional savings account, Method D, ends up with about $259,000. The IBC system, Method E, ends up with over $964,000.
Wow, nearly $700,000 more.
Yep. And that huge difference represents the financing costs and profits that, in Method D, went permanently to the external bank's owners, but in Method E, were recaptured and kept working inside the policy owner's own system.
That really illustrates the power of recapturing that interest flow. And there's a business example, too, equipment financing.
Yeah, a great one. A logging business owner. He needed a new truck, cost about $52,600. Instead of getting a loan from the usual finance company, he borrowed from his existing IBC policy. And then, crucially, he made the exact same payments, including interest, back to his policy that he would have made to the finance company. Just redirected the payment.
Right, the discipline part.
The discipline part. That one decision, financing that single truck internally and repaying it properly over the next 36 years or so, resulted in his policy's cash value at age 65 being over $470,000 higher than it would have been if he'd just financed externally and let the insurance company lend his cash value out to someone else.
Just from financing one truck differently. Incredible.
And this concept scales up, especially when you think intergenerationally. Back to the forestry idea, what Nash called achieving an even distribution of age classes in your financial forest.
Meaning policies at different vintages.
Exactly. Start policies for your kids or grandkids. The book shows an example, maybe putting $2,000 a year into a policy for a child for 22 years. That's $44,000 total outlay.
Okay, a manageable amount over time.
Right. But because of the decades of uninterrupted compounding and potential financing uses, that relatively modest $44,000 input could eventually generate something like $225,000 per year in tax-free retirement income for the policyholder later in life.
Wow.
Plus, still leave a $6.3 million tax-free death benefit to the next generation. It becomes a perpetual wealth machine if managed correctly.
So it really transforms whole life from just a death benefit into this dynamic engine for financing your life and passing on wealth. Hashtag tag Outtrack today.
Absolutely. But to make it work, it always circles back to your behavior. You have to follow the two main rules Nash lays out for running your own banking system. Number one, don't be afraid to capitalize it. Pour money in, especially early on. Volume and velocity matter.
The system.
Feed the system. And rule number two, don't steal from your own grocery store. Always, always repay your policy loans with fair interest, just like you'd be forced to repay any other bank.
So for you, the listener, processing all this, the takeaway seems to be that the success of this whole concept doesn't really depend on finding the best insurance company or chasing market returns. It depends mostly on your behavior.
That's it entirely. Your discipline over decades, your imagination in seeing financing opportunities, your commitment to faithfully repaying yourself. That's what drives the profitability.
Not the external factors so much.
Much less so. The mechanism itself, the policy structure, creates this massive ongoing financial tailwind for you. It helps everything else you do financially. The system works. But, as Nash liked to quote from the Bible, John 5.6, the real question is, do you actually want to get well financially? Are you willing to do the work, change your mindset, and stick with it long enough to see the infinite possibilities? That commitment, that decision to break from conventional thinking, that seems to be the real key.
A powerful thought to end on. Definitely gives you a lot to consider about how you handle your own finances.